was packed full of information this week. We had a PPI report, which is the Producers Price Index. We had the CPI report on Thursday, which is the Consumer Price Index. And then on Friday, we got a retail sales report. And Derek, none of them were very good.
No, both the PPI and the CPI were hotter than expected. The core rate up 6.6, well above the Fed's target of 2%. So the expectation now is pretty certain that they're going to raise the Fed funds rate at least 75 basis points in November.
And again, Derek, as you said, that is expected. But all of this certainly had some information inside of these reports that I found curious. One of the most was the retail sales report on Friday that showed that a lot of the strategic petroleum reserves being exported raises the GDP report. In other words, we saw that the GDP was supposed to be positive in the third quarter, but if you take that out, it's flat. That means the first quarter was negative, the second quarter was negative, and the third quarter was flat at best. And that, of course, is a concern, especially when you start talking about what could happen in 2023 with a potential recession, and that's about a 50% probability. So a lot of information that is out there right now. The takeaway, of course, is that there is a bifurcation between what's happening in the stock market and what's happening in the economy currently.
Right. I mean, typically the stock market sniffs out economic weakness 6 to 9 months in advance, and you could argue that we're basically 9 months off of the highs we made in early January. So that's one reason why you want to at least have somewhat of a glass is half full approach to investing. The second thing is what we're really trying to figure out is what is the impact going to be of this strong dollar, slowing economic growth on corporate earnings, and we're just beginning earnings season as we speak.
And you think about what's happening with earnings, and we have been talking about this for a significant amount of time. If earnings have come down and price to earnings have come down, where is the fair market value? And we're trading at a number right now that some will argue is at fair value, but we had a rip-roaring trade on Thursday that opened up down 500 points, flipped around, and ended up positive 800 points. That was a 1,300-point swing within the middle of the day. That could have been a technical trade.
Well, and in actuality, it was only the fourth time in history that the S&P 500 at one point was down more than 2% on the day, and then was subsequently up more than 2% on the day. So a lot of people got caught short options and all sorts of other derivative strategies. And it does, some of the technicians point to that as perhaps a selling climax, and we'll see. But, the earnings reports that we got on Friday, I thought were pretty good. JP Morgan was a good number, United Healthcare, Wells Fargo. We know about the Albertsons and Kroger merger, and Delta, the airline company, also reported a good quarter. So the consumer still is in pretty good shape.
And that's what people have to pay attention to, is that the earnings are the real story. And so I know there's a lot of effort and attention put towards the Dow Jones and the S&P 500. But once you start to break that apart, and remember, there's 11 sectors in there right now, where does that money go, and where is investment dollars going, and where you should be positioned as we go into 2023. And that's why earnings season, which is really going to kick in next week, folks, is going to be something that we have to pay attention to.
And one of the cliches is money follows earnings. Companies that generate earnings, have high free cash flow yields, sustainable business models, they tend to be rewarded with higher multiples. And, and we're still continuing to see the sell-off in the very expensive technology names who are trading at more than 10 times revenues. That's ongoing as interest rates rise. And I will point out that for the first time, the 2-year now hit 4.5%. Think about where we were just a year ago.
Yeah, so 4.5%, and the Fed funds future rate is suggesting 4.75%. So that means it's got to go up a whole lot yet, folks. And so pay attention to that over the next few months as the Federal Reserve raises rates.